Since the mid-20th century, the global financial system has rested on one universally accepted foundation: United States government debt. Central banks worldwide have held trillions in US Treasuries as the bedrock of their reserves. Engaged. This chart tracks global central bank reserves. For the first time in 30 years, the lines are crossing. Gold now makes up 27%, while treasuries fall to 22%. After the United States severed the dollar's final link to gold convertibility in 1971, the metal's monetary role appeared to be over. Throughout the 1990s and early 2000s, Western economists routinely dismissed gold as an archaic, barbarous relic, an inert rock that produced no yield and had no place in a sophisticated modern economy. During that period, central banks were net sellers of gold. They favored the liquidity of AAA-rated US Treasuries, which allowed them to manage international payments with ease. Curious, central banks are conservative organizations that plan their reserve strategies in decades. For them to systematically reduce treasury exposure in favor of physical gold, they had to be reacting to specific systemic threats. In 2022, the United States and its allies froze approximately $300 billion of Russia's foreign exchange reserves following the invasion of Ukraine. For nations outside the Western alliance, the message was unmistakable. Sovereign reserves held in Western financial infrastructure can be instantly disabled by political decrees in Washington. Diversifying away from the dollar suddenly became an urgent strategic priority for major economies. China began reducing its U.S. Treasury holdings by hundreds of billions of dollars, seeking assets beyond the reach of Western sanctions. Physical gold became the primary beneficiary of this panic. It has zero default risk and exists entirely outside the dollar-based financial architecture, meaning it cannot be frozen by a foreign government. The 2022 freeze shifted gold's role from a simple inflation hedge into an essential instrument of national financial sovereignty. While geopolitical tension drove demand in the East, a bureaucratic rule change opened the floodgates in the West. In July 2025, the global banking system implemented the final phase of the Basel III endgame reforms. These new rules officially elevated physical gold to a Tier 1 high-quality liquid asset. Under previous regulations, gold was excluded from liquidity coverage ratios. Banks were penalized with capital inefficiencies for holding it, as it didn't count toward the reserves they needed to survive a liquidity crisis. Under the new Tier 1 status, unencumbered physical gold is counted at 100% of its market value. This places it on exact equal footing with cash and top-tier government bonds on a bank's balance sheet. This rule applies strictly to allocated physical gold. It intentionally excludes paper gold like ETFs or derivative contracts, which do not receive Tier 1 treatment. By reclassifying the physical metal as a top-tier liquidity asset, Basel III essentially legislated gold's return as real money, allowing banks to bolster their resilience while driving massive new institutional demand. This chart shows the resulting buying spree. Geopolitical risk and regulatory upgrades have driven central bank gold demand to the highest levels in decades. This structural demand comes from price-insensitive buyers who hold assets for years, creating permanent supply pressure that ignores daily headlines. This is not a return to the rigid gold-backed currency systems of the 19th century. Instead, gold is functioning as a behind-the-scenes apex reserve asset. It is the neutral bedrock of national balance sheets in a fractured world. The very architects of the fiat dollar system are quietly rebuilding the global financial architecture, using physical gold as an increasingly central anchor for its new foundation.